Let's now turn to the advisory. What would your life look like with $3,000 a week for life, at least to retire on? Our next guests highlight how $3,000 is a feasible goal and indicates the biggest myths holding investors back. Joining us to talk through that is Ben Kingsley and Bryce Holdaway from Empower Wealth, also authors of How to Retire on $3,000 a week. Welcome to you both.
Thank you. Thank you.
Ben, $3,000 a week. Sounds like a lot of money. How do you possibly generate that? Perhaps, are you talking about it passively?
Yeah, we are talking about basically in concert with super. If you buy a couple of smart investment properties over a reasonable period of time, then that time will allow for that passive income to build up. And so that's how you get to the $3,000 mark.
So is this a balanced portfolio? You're talking about obviously super. Do you have shares plus property?
In this particular case, we're talking about residential property. So depending on how long you've got, so you might need 2, 3, maybe 4 investment properties, maybe bought over a 12-year to 15-year period, and then you're just basically letting that time tick on. So you've got super, which is now 12% compulsory coming in, and so you're letting that build up, and then ultimately what you're doing is you're adding to that through a portfolio of properties which will bring that passive income.
Bryce, what is it about property, residential property, that's particularly attractive then where you can possibly earn that amount of money?
I think it's almost backed at the ballot box. It's too big to fail. So the fact that it's an essential need, it's the only investment market in the world that's not dominated by investors. And we've got in this country a housing policy and an immigration policy that aren't in alignment. It's kind of like a bath with the tap on and it's overflowing. So the fact that there's more people who want housing than is available has a really good supply-demand trend. So it's tangible, it's easy for people to understand, and to Ben's point, if you combine it with super and just maybe get a couple of investment properties over your working career, a passive income at that 3,000 level is achievable.
Well, it does sound simple the way you put it, but of course it's not, is it, to begin with, of actually getting your foot on the property ladder, be it buying your first home as an occupier. Then how do you actually leverage yourself and get into investment property?
Well, I think if you already are on the ladder, that's the hard work done, because for a lot of people they've built up equity in their home via growth and paying down the loan. So they can use that as a resource to buy an investment property, typically with all of the resources from the bank largely backed on providing to security to buy the investment property. And I think it is ridiculously easy, the process. I think for a lot of people it's the mindset that's the hard bit. So we're used to working for money instead of having money work for us. So it's largely changing the paradigm in our head is the hardest part, because once you've done that, the mechanics of buying, to Ben's point, over a 10 to 15 year period, 2 investment properties is probably not that much of a stretch for most people, but overcoming some of the paradigm shifts is the hard bit.
Ben, is 2 the magic number, or how many properties do you need?
Well, it depends on your current situation. So if you've got a long period of time, we're talking about sort of 20 or 30 years before retirement. So if you're starting to buy an investment property in your 30s, then 2, possibly a third one might be all you need. If you're a little bit later in life, then we're going to change the strategy a little bit. So you might need a couple more where you've got a higher yielding property, as opposed to something that might necessarily have the capital growth of some of those, what we might call blue chip or prime locations, and you get a couple of entry-level location properties in there as well.
Well, to that point then, what type of property should you be aiming for then? Obviously, we talk about location,
Yep.
being an apartment, a house, you talk about obviously the potential there for rental yield.
Yeah, so it's a great question, and ultimately it still comes down to what are we trying to fit into your lifestyle and into your overall investment goals. So if you've got really strong super and you've got really strong income, then we'll try and chase down houses with a lot of land to asset ratio in the big capital cities. If, for instance, we don't have that and we need to get that extra cash flow, then we might go to what we call commutable locations, which are drivable to the major employment centres, but they're just, the sort of regional towns that are building up off those. And off the back of that, we normally get a higher rent, and that is obviously part of that passive income that we're building up.
Is Bryce, at all about that yield, or are you also trying to chase that capital growth, perhaps with the potential of buying and selling, dare I say, flipping properties, or are you actually trying to build up that capital?
Our bias is for all things being equal to chase the growth, because that will increase the wealth base, and by default that drags the rental income with it. But the reality is for some people, they just can't afford to go growth first. So there's three buckets that we sort of classify. There's high growth, low yield. There's more of a balance where you drop a bit on the growth, you get a little bit more yield. And for some people, it's just chasing properties where they're in locations where the growth prospects are probably less likely, but the yield is high. So horses for courses, but all things being equal, we would favour growth properties for that wealth base increase.
Ben, what about timing? In fact, we just spoke to Cotality. We just got the latest details, property prices, all those home values up again this month. Clearly generated by these rate cuts is now a good time to actually invest.
Well, I think it's really important that the household looks at their own financial situation. So we're always a big believer that you invest when you can afford to invest. And then when you start focusing on the location, yes, we want to look at the economic drivers. We want to look at the human interest and human behaviour, because at the end of the day, when we talk about location from a property point of view, what we're talking about is those desires from an owner-occupied point of view that puts a little bit of pressure on that land and that location, and that drives up values over time.
Bryce, what are the risks you need to consider?
Well, you are getting into a leverage position, so you need to, for me, the first benchmark you need to go through is make sure that you spend less than you earn. And as simple as that sounds, it's amazing how many people don't do that. So it's having a demonstrable run rate of being able to trap surplus, and then if you can do that, then being able to demonstrate that you can service additional debt. So for me, the risks largely are around not being in control of money management in the household, because if you are buying one or two, we're not asking people to buy 10, we're not asking people to do development, renovate, subdivide. We're suggesting passively add 1 to 2 investment properties combined with your super over your working career. So we think the risks can be managed, but if you can't manage basic households' cash flow, that's a real red flag.
Because we did hear those stories off the back of COVID, obviously, where interest rates were next to zero. That proved to be very attractive for property investors, at least to get into the market, courtesy of Philip Lowe, who was talking about, see these rates rising.
Back in the day. Yep.
And subsequently, we had these anecdotes of people that had actually leveraged to the hilt, interest rates went up and they were forced to sell. Was that a trap?
Yes. They violated a massive principle of the long-term interest rates. The average was 6.5, and they were getting, the cash rate at the time was 0.1. So they made the mistake of thinking that was going to last forever. So for those people that had a buffer in place, they were annoyed by interest rates going up, but it was part of their planning. For others who thought that was going to be the case forever, they were the ones who were not only cash flow challenged, but then forced to make decisions in positions of weakness.
Are we purely talking about residential property, or would you venture into commercial?
I don't think you need to, risk commercial. Obviously the downside risk of commercial is vacancy. So if you've got a tenant for 5 years and that's all great, but all of a sudden you've then got a vacant asset. So that income is critical to obviously help service the debt. One thing we love about residential property is it's an essential need. It's shelter. So from that point of view, it does provide for a better situation in terms of mitigating some of that risks. Obviously, there are other costs associated with running a small private rental accommodation business. So you want to make sure you've got quiet and safe enjoyment for the tenants in those properties. But we would like to think that it's best to start out with lower risk, which is in the residential space. If you want to continue to build out your portfolio over time, maybe commercial might be something you consider.
So Bryce, what actually prompted you to write this book?
A couple of things. One was we wrote one back in 2015, and we started a podcast soon after, and we had a decade of maturing in our thinking, interviewing some of the best talent in this country, including your previous guests from Cotality. So that sort of helped us shape the views and the frameworks that we did over time. So it started out being a revised and updated edition, and then it quickly morphed into a totally new book. That one of the things that we liked about the first one is it was evergreen concepts that you could pick up and apply today and in 10 years' time. We made it even more evergreen going forward. So it's a passive play. In fact, if you're either active or passive, the book covers you both right up into the last section where there's the case studies, but the 7 case studies that we do at the end are very passive. There it's 7 demographics on how you can retire on $3,000 a week without betting the farm and without giving up your weekends and renovating.